Visa is one of the most profitable companies in the world, generating operating profit margins that are approaching 70%. Interestingly enough, investors are becoming more interested in Visa stock nowadays. It used to be known as more of a boring stock that grows steadily, but now investors are getting more interested because of the excellent performance of this business. So, what's a fair price to pay for Visa stock? What's the intrinsic value of Visa stock? That's the question I'm going to answer in this video. That's what I'm going to calculate in this video using a discounted cash flow valuation model to price Visa stock. So I'll share with you precisely where I'm getting all the numbers and estimates and adjustments I'm making so that you can see for yourself all of the inputs. And so you can determine if my inputs are too pessimistic, too optimistic, or on point. So let's get started. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, one of the numbers I need is the market cap for Visa at 604 billion. I also need the company's number of shares outstanding, which stands at 2 billion. And you can see it trending downward here. Visa has been buying back a lot of their own stock because the company generates so much cash from operations and the asset-light business model doesn't need so much reinvestment. And so Visa can return that capital to shareholders. I also need Visa's long-term debt, which stands at roughly $21 billion. And finally, the cash and equivalents balance, which stands at roughly $12 billion. I also need the estimates for Visa's free cash flow going forward several years. And for 2024, the estimate is for $18.7 billion in free cash flow, rising to $23 billion in 2025, to $24 billion in 2026, to $28 billion in 2027, to $32 billion in 2028, and finally $37.6 billion in 2029. Following 2029, I'm going to have the company's free cash flow forecasted to grow at a transition period growth rate for several years and then settle down to a longer term growth rate thereafter. I'll share with you precisely the numbers I'm using for those rates of increase. So now that we have all of the numbers I need to make my valuation, I can jump into my model here, my discounted cash flow valuation model for Visa stock. And this is as of December 6th, 2024. Let's start with the free cash flow for 2024, starting with 18.7 billion and then growing over the next several years using those estimates from Wall Street analysts that are following Visa stock. Okay. Then starting from the year 2030, I have the company growing at a transition period growth rate, which I have at 7.5% between 2030 and 2034. The reason I used 7.5% is because the initial 5-year period estimate coming from Wall Street analysts had the company's free cash flows growing at 15% in the short term. And so I have it growing at half of that rate in the transition period at 7.5%. Then, starting in 2035, I have the company settling down at the longer term growth rate of 5%. So I have it going from 15 to 7.5 to 5%. Okay. Now, since these are forecasted free cash flows in the future, we need to discount them back to today to get the present value of those free cash flows. And so we need to get a discount rate. The weighted average cost of capital I'm using is 9.76% for Visa. I'm getting that number by assigning an 8.5% cost of debt for Visa by adding roughly 430 basis points to the risk-free rate of 4.2%. I'm assigning a capital structure of 90% equity and 10% debt for Visa, given the company has 21 billion in debt and a market cap of 604 billion. A market risk premium of 6% with a beta of 0.95 gives me a capital asset pricing model cost of equity of 9.9%. I got the beta from Yahoo Finance of 0.95. So that's how I arrive at the weighted average cost of capital of 9.76% for Visa stock. So when we apply that discount rate to these cash flows over the next decade, we get the present value of cash flows of 218 billion. Now, I could forecast these free cash flows all the way out to infinity, 1 year at a time, but that would be more tedious. We could use a terminal value shortcut to bring forth all of the cash flows expected by Visa between the year 2035 to infinity, because theoretically, a corporation can survive to infinity. It could go on forever. And so to bring together all of those values between 2035 to infinity, we use the terminal value formula, which takes the free cash flow 1 year ahead, divided by the weighted average cost of capital minus the growth rate. And so that brings us to the terminal value calculation of $1.2 trillion for Visa. Again, this is the value at 2034. So we need to get the present value of the terminal value. Applying that same weighted average cost of capital brings us to a PV of terminal value of 480 billion. And when we combine those, the PV of cash flows and the PV of terminal value, we get the value of operations at $698 billion. All right, we're not done yet. We're almost there. To that value of operations, we need to add the cash balance of $11.97 billion and subtract the debt of $20 billion. That brings us to the value of equity of $689.6 billion. That's the value of equity of the entire company. We want to know what the price per share should be. So we want to divide that value of equity by the number of shares outstanding at 2 billion. And that brings us to the intrinsic value per share for Visa stock of $344.81, compared to the current market price of $311.14. So our intrinsic value calculation, or my intrinsic value calculation for Visa stock, has it worth $344 per share. Now, this doesn't mean that the market price will ever reach the intrinsic value that I've calculated. This is just what I feel the company is worth based on these figures that are available to me. The market price can disagree with my calculation of Visa stock for a year, for 10 years, forever, potentially. It doesn't always approach that value. But the theory goes, or the thinking goes, that eventually the market will realize this intrinsic value for the stock. Like a barrel underwater, eventually it will come to the surface. That's the thinking with these discounted cash flow valuation models. Still, you should do your own due diligence. Look at these numbers as inputs, as numbers that I've used as a calculation that I've made, and make adjustments yourself where you feel I made mistakes, where you might think my weighted average cost of capital is too low or too high. You can make your own adjustments to make that calculation yourself. In all cases, should be used for informational and entertainment purposes only, and please conduct more due diligence before making a decision on any of these investments. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.